Good afternoon. This weekend review for the Tortoise Trading Reports, New Year's edition, December 30th, 2017. We have a market that's in bullish normal conditions. On an annual basis, using weekly RSI 14, we are overbought at 82 out of 100. On the 10-day NDX, the short term, we're in the middle of neutral at 46 out of 100. Looking at the market Mosaic, price with respect to the 200-day moving average is green bullish at 7.54%, meaning we have 5.5% cushion to the 200-day moving average boundary for sideways. 5-day slope of the 50 has improved to white bullish 0.45. ADX is strong uptrending at 25.6. The risk index is the 30-period moving average of the VIX divided by the 10-period. That reading is 1.014, so we are in risk-on conditions because the boundary between risk-on and risk-off is 1.0. So we are in risk-on conditions. Take that score and look at the last 5,000 trading days, find the standard deviation and average, and we compute the risk Z score at 0.06. This is a 90-day histogram of that indicator. You can see that we've recently hit as low as -2 SD. This was a period of very high volatility and very quiet volatility, almost 1.54. A couple swing lows here around 0.05. This has been a good swing trade period here as volatility has declined. It's now back to the zero line, though, at the end of the year, meaning that the possibilities of volatility events, intraday short-term spikes against the bullish trend are certainly possible. That's what happened in this period here and in here. So when volatility has come back to the zero line, then there has been a slight increase in volatility, which means that there have been traders probing weakness on the south side. In blended month rebalancing, we will be rebalancing to these positions when the market opens. The next reevaluation will be due on 1 February. So the current holdings going into January will be these for these three ETF populations. And that's based on the closing prices as of Friday, and you also see the leading candidates for the other some other sectors. In ETF2, the theoretical exposure is at 90%. There's just a quick look at some ETFs from the ETF blended month rebalancing portfolios and where they stand. They're on buy signals if they are above their 4-month moving average, cash if they are below. And this is ranked on the basis of the blended 3-month and 6-month performance. You can see everything is on a buy signal except for Latin America and real estate, U.S. real estate, with diamonds, conservative U.S. large caps leading the way, which have been exceptional compared to all their peers on the 1, 3, and 6-month percentage. So conservative U.S. large caps have been really dominating. ETF 32 expands that slightly and includes some sector spiders and some that are more broadly broad indexes, like you see Brazil here is on cash, similar to ILF, although it has had a 1-week turnaround after underperforming over the last 3 months. So that will be certainly one that we're going to look at. As you can tell, I'm always looking at Brazil. It's broad, it's liquid, it has options and futures, it has its own currency base. It's not Asia, it's not Europe, it's not the U.S., and so it becomes an interesting, least correlated index for trading, and that's why ILF is of interest as well. The sector spiders, this looks at the elements of the U.S. S&P broken out by something like 32 different sectors, a little more expansive than the XL, the pure sector spiders, so this goes a little bit more broadly. Metals and mining, capital markets, oil and gas exploration looks interesting. Oil and gas equipment has had a little bit of a turnaround as well, a good 1 week and 1 month. The laggards have been internet, telecom, utilities, and facilities, innovative technologies. ETFMax, this looks at about 500 very liquid ETFs, and ranks them again by the blended monthly. So what I look for are either red or green in the 1 week as ways of looking at potential momentum plays. So if it's all green, and yet I see some red, now China Technology and Sector Spiders have had a sharp 1 week pullback compared to their peers. Is this the beginning of the end, or is that a buy on dip opportunity? Same with China Technology here. At the same time, pure beta nickel and crude have been green across the board and had very strong 1 week performances. So that is either a candidate for additional momentum buying or a sharp reversion to the mean. In either case, we're likely to see a larger than normal 1 week move, and so that becomes interesting because it's at an extreme condition compared to all the peers. This is the weekly market health check. The vertical blue lines are 10, 20, and 30 days of look back, 40, 50, 60, 70, 80. Horizontal red lines are support levels that used to be resistance levels on the way up. If price collapses here, then these red lines become price targets on the way down. The 10-period regression channel is still sloping up and price right in the middle of that channel. The 30-period regression line, a stronger slope up, so there's been a short-term pullback while the 30 has been steaming along nicely, and now price is near the bottom of that channel, and that suggests real strong support for me around 265. That's important, or even 264 at this red line, which is that swing low, and that would be halfway back through the river towards the Bollinger Band mean. This sine wave looking line is the moving slope of the 30-period regression line, which I take to be the health of the trend, and so it peaked here just like it peaked here. This one peaked at 0.435. That's one standard deviation greater than the long-term average. So that was really an exceptional move over the last 30 days to this point. And so this sideways motion, which is basically zero over the last 4 days, should be seen as a normal cooling off period after a really strong upward move, and especially going into the long weekend with the risks political and security-wise that are likely to be there. So this was a part of a normal pullback that you would see here. In the previous iterations, like this one, there was a rebound. This one, there was a rebound. You have to go all the way back to here to find the next one. There was a rebound here. So it would not surprise us to see it cool off and then gain some support going into the new year. There is new pension money going to come into the markets in January, and the U.S. sector spiders and the large caps are the current leaders, and so that's an easy play, and the S&P would benefit from that. So this would not surprise me to see this simply as a pause that refreshes, similar fashion here and in here, that followed up with another measured leg up. There's been little to no follow through and downward selling pressure, but if so, these would be the price levels on the way down. Slope of the river is up. You can see the 200-day moving average here. We got that 5.5% cushion to sideways market conditions. We have the PPO, which is essentially the MACD, has, however, rolled over to the downside, and so this keeps us cautious. You combine that with a new year and some geopolitical risk and volatility creeping up slightly, and there is some room for cautious optimism now. The zero line is all the way down here, though. That's where we'd have to see this line come down to cross to have a negative view on the market. So this sine wave here shows you the slope of the 30. This is all well within normal. It's still at a positive 0.37, which is still an extraordinary good move into 30. But if we were to see this lower leg of the channel as support, you can see the support at 265 and 264 is kind of crucial. So cautiously optimistic here. Whoops. All right, next up, the ETF Regional Report. Everything is on a buy signal, less ILF. The S&P at 70 is stronger than EFA at 64, so the U.S. is stronger than the globals. Inside the U.S., it's technology at 72. The S&P at 70, then mid caps, then small caps. Everything in the U.S. above average except for those small caps. The two strongest sectors are the S&P and U.S. tech. The two weakest sectors, Latin America and Japan. In the 9 sector spiders, leading the way, technology, financials, consumer discretionary, laggards, staples, utilities, and healthcare, the defensive plays. In the world market model, again, you see the small caps slightly below average. The Dow looking very strong among the U.S. Japan above average, Asia less, Japan below average, a mixed bag in the Asian countries, mixed bag in the Euro countries. Emerging markets doing better than Latin America and Brazil. Mexico really lagging. Oil dominating, as is tech. And private equity, the hedge funds are not doing so well. Europe slightly below average. The ETF top 30, using that the ETF2 lens, strength in oil, home construction. What I'm looking for here are, as candidates, are green and then white. So green on the strength means it is among the upper 15%, so more than one standard deviation above the database average. And then the consistency is a 10-week moving average of strength. And so things that are green and green have been long and strong for a long time, home builders. Green and white means that it has been above average for 10 weeks and now is becoming even better. So green and white is the next strong leg up into the elite from the above average. So that leads me to South Africa, metals and mining, Chile, and conversely, things that are white and green, like total dividend in Japan, and financials, these had been exceptionally strong for 10 weeks, but now have sunk down into the white, so they were just simply above average. So that could be losing steam in that sector. So I use this as a ready reference for long-term swing and position trades. So I'm going to take a look at metals and mining and Chile for that reason. And I'm also going to look at XLF as a way to see maybe is that going to resume some of its strength in the new year. These are the liquid ETFs on the basis of average daily dollar volume over the last 30 days. And the ATR percentage shows you how relatively volatile they are. The ones that are on this list that are in the green are excellent candidates for short-term trading because they're very liquid and very volatile intraday. So the VIX, gold miners, Brazil, this is one of the reasons I love it as a trading vehicle and as a swing trading vehicle, day trading and swing trading. XOP for oil and gas, and then the regional banks. Shifting to the daily report now. We've seen all these again. Now the 10-day max pain. These are the symbols in each of these 3 categories that have lost the most on a percentage basis from their 10-day high. I'm going to look at, let's see, Intel for sure, because tech has been great and the Dow has been great, but Intel is one of the weakest, so that's the anomaly. And I'm thinking maybe that may be a buy quality on weakness opportunity. Disney, just because it's the number 1% loser. The 10-day min pain, these are the ones that have lost the least from their 10-day high, and this would be an easy momentum play, especially CAT and United Tech, because the Dow has been so strong and they have lost the least. That makes them relative strength leaders. I'm going to look at Chevron too in the energy sector in the Dow, because energy is very strong. Among the pattern mechanical swing setups, there's plenty of goodies here in the channeling to look at. There's technology, there's Disney, 3M is a favorite of mine, as is Johnson & Johnson. So that's another reason here to take a look at Disney. Apple is an overreaction. Triple screens, Disney, 3M, United Health, 551Ws is a real favorite of mine. I like the fact that Disney is on there, and Johnson & Johnson, another one of my faves. That little chirping you hear in the background is we are dog sitting for a little Australian cattle dog, a red heeler. She's as cute as she can be. The auto framer, these are all the symbols that are that mechanically test out better than 2 to 1 on a simple retest of their 10-day high using Friday's range as your risk. So if it makes a new high or takes out Friday's high and you use Friday's low as your initial stop, then these all test out at better than 2 to 1 on a simple retest of high. So I like to see Disney, Intel, Pfizer, and McDonald's in there. So I'm going to add McDonald's, one of my trading favorites. Microsoft too, because that's U.S. tech, and it has a favorable mechanical frame. Just some quick looks. Again, you see all the channeling and overreactions. Plenty on the auto framer to choose from. Lots of 551Ws. That means it's been down for 5 weeks. Correction, it's up compared to what it was 5 weeks ago, down compared to 5 days ago, and it had a white candle closing on Friday as a 1 day of momentum. So that's buying the second day of momentum. I like that Microsoft, Disney are both on there. There's no RSI2 values below 10. There's one good frog number in there at GE. Now, what makes GE interesting is that it was a 1 day winner here with a 0.52%. So thus it's in the green compared to its peers. But compared to the 1 month, 3 months, 6 months, and 12 months, it's down enormously. And yet it was a big leader on Friday. Now, GE is a must-own for long-term portfolio managers. It's in the finance and tech intersection. Can be a proxy for the market. I like the fact that it's been horrible and yet was a big leader on Friday going into the new year. If you have some beliefs about sector rotations and people smoothing off their portfolios and shifting money from the winners to the losers to get some dollar cost averaging, then GE would certainly be a logical candidate for that, as would Merck, because that's been a big percent loser over the last periods of time. So I'm going to add Merck into my list as well. You can see the big winners down here: Caterpillar, Chevron, Intel. I mean, look at Caterpillar, for crying out loud. Up 7.5% over the last 10 days. Up 70% in the last year. A real growth stock. Oh no, it's Caterpillar. They sell bulldozers to miners. That has been one of our standard swing plays the second half of this whole year. We've been following that in the chat room with great interest and with some good reward to risk. So I like me some Caterpillar. ETF 30, using the same kinds of logic. You see a couple of the defensive plays there. Utilities and real estate test out very well on the auto framer. Mexico, gold and silver, and the VIX were all percent winners. You can see the VIX has just been, XIV, the inverse of the VIX, has just been extraordinary as a swing trade and as a day trade. If you've been following us in the chat room, you've been able to exploit that. So Mexico, again, is going to go on my list because compared to its peer group, it's been exceptionally weak on 1 month, 3 months, and 6 months, and yet it was a percent winner. So that's postured for some potential gains, and it was the second biggest gainer in the market. So I'm going to add Mexico. That pullback has been enough. It's going to go back on my always list. And you will know from, if you've been with us any amount of time, that Mexico is one of our super frog candidates. Is exceptionally froggy intraday, and so I really like this posture of big selling, then not so bad, and then a percent winner going into the weekend. I think it's going to be well postured for some sector rotation money coming into Mexico. From our pinch and stretch report, 4 categories. The most positive Z stretch. These are the 1 day excursions and how far above their 30 period Bollinger Band mean they are on a percentage basis, and then this computes that as a Z-score function compared to its own stretchiness away from its this sort of takes into account current location compared to its historical volatility. So these are going to all be at least one day exceptional moves well outside the river. These are the most negative Z stretches, utilities and Apple. The most expanded pinch box, this looks at the width of the river, and the ones that are more than one standard deviation wide compared to their history. This means that they have had exceptional directional moves in the last 30 days that has caused the river to be very, very wide. So you see things like XLU is exceptional, but the stretches to the downside, as we can see over here. Whereas Caterpillar, United Tech, Chevron, Diamonds, these are all extremely wide rivers, but all to the upside as well. That's how we read that. So in this case, when there's already been an exceptional move, I am looking for momentum plays or reverse momentum plays. It's either going to be a continuation of the buying-selling pressure that has caused it to be so directional, or it's going to be a reversion to the mean trade. And now I can frame that trade in either direction and expect a larger than normal move from them on the basis of the fact that the last 30 days have had an extraordinarily cumulative directional move. The most compressed pinch box, these are the ones where the river is exceptionally narrow and are poised for breakouts in either direction. So I look at Apple as extremely pinched, and yet it has had a sudden sharp move away from its 30-period moving average, and so that tells me that this is the beginning rather than the end of a directional move for Apple. So Apple is definitely going to go on my list to frame. Now if we take the pinched compression, the absence of large directional moves over the last 30 days is what causes them to pinch so tightly. I like the fact that Brazil is on there ready to go as well. We then take a look at the four regression lines, the 10, 30, 90, and 270, which represent fair value on different time frames. And when all four of those are very tightly pinched inside a narrow price range, then they make it to this chart. So it's a combination of tightly pinched and all of the different time frames agree on fair value. That means it's poised for an exceptionally large breakout. So we have the old Dow and DuPont, Brazil and Apple. I'm going to love this one, Brazil and Apple especially, but DWDP is an old-time favorite of mine. So I'm going to add that to my list, so plenty to choose from. The auto framer, we've seen these symbols before, and this gives you the mechanical price levels of interest, like 10-day highs, the size of the stop, where the mechanical entry would be at 5 cents above the previous day's high. And then the regression line fractal framework, these are taking a look at the differences between the RL10, the fastest regression line we look at, and the 270 regression line, which is the long-term buy and holders estimate of fair value. And so what this set of tables does is looks at the distance between the RL10 and the RL270, expresses that as a multiple of ATR, and the ones that are in the green here on the top shelf, these are value plays, the ones that are the most numbers of ATR below their own RL270. So I already know I'm going to like GE because that's 7.5 ATRs below its long-term fair value, all the way down here to Apple and McDonald's, which are around 2.8 and 3.0 respectively. The symbols in the red on the bottom shelf, these are the ones that are the most numbers of ATR above their own RL270, or in other words, and they're in red because they're showing it, I think, as overheated perhaps, or how far away they've stretched to the upside beyond long-term fair value. And so you see things that are relative strength winners like Chevron, Caterpillar, and Home Depot, all either 8 to 9 ATRs above their RL270. So Home Depot's a favorite of mine, so I'm going to add that to my prep list, and so on for these other populations. As you can see, we're already developing well over a dozen of excellent symbols just from inside the Dow 30 and the ETF 30. So in these conditions, I really don't have to go further, but this is a sound practice for swing trading on the basis of trade location. These are daily squeezes. This is a case where you have a symbol that has historical average ranges that are wide, and yet the range from yesterday or the last trading day was so narrow that if it takes out yesterday's high and you use yesterday's range as a unit of risk, you get better than 2 to 1 if that thing just has a normal average range move. So these are like tightly coiled springs that are one-day pop opportunities. And I love the fact that Disney, Caterpillar, Microsoft, Intel, Home Depot, McDonald's from my list are all on there. That tells me these are all postured for significant large one-day moves, which can be used to pay for swing trade risks. If I can get a one-day pop with a turbo position and earn some risk capital from the low-risk intraday move, then I can keep a piece of that overnight, and I'm really gratified to see that so many of my standard tradables are on that list right now. So now we'll just take a quick look at the market mosaic. You can see the slope of the 30 has rolled over slightly here with the polynomial regression line. You can see that the slope of the 30 got to 2 standard deviations above normal and then made a crossover at a point more than 1 SD above the long-term average. And that tells me that something we already know, and that is that this has been an exceptional move and that it has cooled off enough that there is a real concern about a return back to normal, and that's what establishes the trade opportunity, is that you can make a strong argument for a big move in either direction. So what would negate all of this, what would bring it back to the zero line, would be a move down here around 258. So you can see there's a 10-point, which is a 5% move, and 5% or less, this would all be considered noise in the long term, so that makes it especially vulnerable for short-term, sharp volatility moves. Here you can see the longer term. This is 180 days. This was 30 days. Now you can see this move in terms of its historical references. Now, notice that when you get these crossovers over its own 10-period regression line, this is a really smooth indicator. So I would tell you a move back to 258 would be absolutely normal. Absolutely normal. And this is the percent stretch above the 200-day moving average. It also was a 2 sigma move, exceptionally strong move in this whole period over the last 90 days. Remarkable. This is that slope of the RL30 now, looking at the last 10 years inside its context. So you can see that last move above 1 was an exceptional move compared to the last 10 years. Looking at the z-scores of regression line slopes, and we're looking just at kind of market conditions right now. The 90 has rolled over outside of the 1.0 river. The 30 has rolled over, is coming back to the river. The 10 has pulled all the way back to its long-term baseline. That's what that cooling off period looks like here with respect to the river. Now, the last time it did that, it found support and made a move. Last time before that, found support at the edge of the river, made a move. Last time before that, failed, came to the bottom of the river, and then set up a long-term grinding up, and it's done that twice. So this is 1, 2, 3 legs. The only thing that makes me think that maybe this is just one leg of the next longer meta cycle is that we're starting the new year with new pension money coming in. So let's see how that all shakes out. That's everything I want to cover from this weekend's report. The rest of them are technical details. We have plenty to choose from here. I'm going to frame up a couple of these and talk about them. But in my own trading practice, I'm going to go through and mark up all of these so that I'm ready to swing and intraday trade them. All right, so we're looking at dailies now, and we're going to talk about the MACD histogram as an additional guide to our simplified RLCO framework here. This is a 2 sigma envelope around price. There's the RL270. This blue is the RL10. So I'm just showing those to keep things a little cleaner. I like that the market was pulling away from its RL270. This is an upward move. The sell-off Friday just kind of smoothed it out. Now down here we have the 1035 MACD histogram. We've placed a 1 period and a 2 period Bollinger Band framework around that. So what I like is that it's above the zero line, so I have a long side bias. The crossover of the histogram line back below the signal line occurred here. This was a good time to sell and lock in these gains. No real further weakness other than Friday's kind of anomaly. It is now into this lava river down here. So this is still normal pullback. The positive signal would be the MACD line crossing the signal line. That would be it would take 1 or 2 days of gains to cause that to happen. That would be a crossover to the upside. That would be a pocket entry, and that would be the formal trigger to keep going. If this signal line crosses below the zero line is where we now adopt a downside bias. Now, as you can see, where we picked up the long side bias was when the blue line crossed the zero line here. So we picked up a long side bias at 245 and have been long ever since. So when you get this nice strong move, a crossover caution, didn't fail, and now cross back to the upside. This is that first pocket re-entry. If this was enough to get you out, then this crossover back to the upside above the zero line is the opportunity to get long again right in here at 251. It crosses over here, caution, note the cautionary pullback, and then you get the next crossover here. This is the re-entry around 260, and it's been good ever since. And even this little sell-off and then recovery was not enough to give us a negative bias. This was a potential re-entry here. You're still in the money if you re-entered there. This would be a prudent exit. But now we're looking to see a crossover to the upside to signal the next leg up. You could even say if it took out the RL10 period, this would be an emerging dragon. So at about 267 would be an auto re-entry for me, unless I can find a way to get long inside here. If we took a look, if we drill down a little bit to even 2 hours, and we'd see that 267 entry would put us right about here. I like the fact that it's stabilized in the last half hour. Now if we look at the 30-minute charts, this is the fastest swing trade. Big sharp sell-offs, and there was a lot of recoveries, and then found support here and put in a full hour of gains going into the weekend. So I consider that to be a pretty strong support if we get an open above here. So the long-term entry would be 267 for sure. And we're getting ready to see a MACD histogram crossover to the upside. So this just looks like a tactical opportunity to buy quality on sale. All right, so let's shift back to the, well, just for the heck of it. When you see the that last half an hour, or that last hour of selling, was gunning stops, and even the trading in the after hours really never threatened this swing low. So I'm really looking at opportunities to get long inside this cap here. I think there'll be some buying opportunities as well. All right, so that's a quick look at SPY. IWM is probably going to show us the same thing. We'll shift back to dailies. Still relatively the same kind of pattern as we saw in the S&P, but more volatile and more pronounced legs. About the same posture, so I'm not going to look further at that one. XIV, or inverse volatility, had even less sell-off than the market. I take that as a long-term positive. I just want to show you here, the last time we signaled along to buy on this one was November 20th, when we got the crossover to the upside and got long in here on a swing at 110, and it's now 20% better at 134. because of that crossover to the upside above the zero line after a nice long move. This was our an early entry in here around 81. When it crossed the zero line, we could officially get positive at this price at 88, and have been long bias ever since. And that's a 50%. That's a 60% gain since the middle of September. And these long tails, there's tremendous intraday opportunities on those. Okay, so the last one I want to show is Caterpillar. We got the dogs announcing that our New Year's Eve friends have come over for early celebration. We're going to celebrate New Year's Eve in London time, so we can have a reasonable hours here. So this is all above the zero line. Notice the crossover to the upside from 117. Another crossover to the upside here at 135. Crossover to the upside, another one at 140, and this exceptional move here in Caterpillar with price riding the 2 sigma Bollinger Band all the way up, hasn't even crossed over to the downside, and just a momentary pause. So if you see any kind of gains continuing into Caterpillar, you should really enjoy that move. Let me take a quick look at Brazil. Yes, I like Brazil. It's found support, high or low. All it has to do is take out 41, so I'm ready to get long on this one if it breaks above 41. And then targeting up here around 43. Yeah, I like this support that it's found all the way through here. Got this nice yin-yang, finding support and taking off some more. I like Brazil to the long side. Mexico even better. I like this swing, and then a 3-day gain off a swing low around 47.5, and upsides at 50, 52, and then 55. So I'm really liking this pattern formation here. The Bollinger Band support down here, and then getting ready for a crossover with a higher low, a higher low, a third higher low, a crossover to the upside, and I'm really liking Mexico there. And if we look at that, if we go out to a weekly, this has some good potential as well. Yeah, it's not going to take much for this to cross over the upside, and then crosses a zero line to confirm. That would really be around 51 is a no-brainer to get long, and I think I can get long here around 50 and start building that position with a target of 58 in reasonable time frame. If it holds support here above the RL270, that's excellent, because the last time it found support around 42, that would be a low, and then a higher low, which will be more evident if we swing out here to the monthly. Yeah, so 4 days or 4 months worth of pullback. The last time it did that, down in here, it found support around 47, 47, 45, and again 47. I'm really liking Mexico long-term fair value around 67, so I'm looking at a 20-point potential gain, and so if it gets above 58, that's certainly a no-brainer on monthly charts. So we have plenty of short-term and long-term swing trade postures. I'm going to go through the rest of my list tonight and maybe tomorrow morning and build out some of these trade frames for the swing trading, as well as my usual suspects, and I think we'll have a rich opportunity for swing trading in the week ahead. So this is already 40 minutes in. Ken Long at Tortoise Capital. Keep your risk measured, your powder dry. Have a safe New Year's Eve and a prosperous new year, and we'll see you in the chat room.